Welcome to the Deep Dive. We're here to cut through the noise and get to what really matters. And today, well, we've got a bit of a puzzle on our hands. Netflix. Their latest earnings for Q2 2025 just landed. And honestly, the numbers look fantastic. Really strong performance. They even bumped up their guidance for the whole year. But, and here's the twist, the stock actually fell, dropped over 5% on Friday. So what gives?
Yeah, it's one of those Wall Street moments, isn't it? Seems counterintuitive. So our job today is trying to unpack this. We'll look at those great numbers, figure out what drove them, and then crucially try to understand what our sources are saying about why the market, reacted downwards. It's like investor psychology bumping up against solid company results.
Okay, let's start with the good stuff then, the actual results. Because Q2 2025, Netflix really delivered. Earnings per share, $7.19. That's a solid, 12 cents higher than analysts were expecting. And revenue, over $11 billion. Again, beating the consensus. Plus, their operating margins hit 34%. That's huge. They even beat their own predictions there.
Right. And it wasn't just a one-off lucky quarter either. You look back at Q1, same story. Big beats then, too. EPS was $6.61, beating estimates by nearly a dollar. Revenue over $10.5 billion. They've got momentum.
So how'd they pull it off this time? What's behind these Q2 numbers?
Well, it's really a combination of things working together. First, they added more members, which is always key. Second, their pricing strategies, the different tiers, that's clearly contributing. And third, and this is a big one, their advertising revenue.
Oh.
It's really starting to fire on all cylinders. The sources say ad revenue actually doubled compared to last year. Doubled.
Okay, doubled ad revenue. That's significant. A real growth engine kicking in, like you said.
Exactly. And it shows that diversification beyond just subscriptions is potentially paying off big time.
And Netflix themselves seem pretty bullish, right? They raised their outlook.
They did. They lifted their full year 2025 revenue forecast. The new range is $44.8 billion up to $45.2 billion. That's a decent jump from before. And they also boosted their operating margin target for the year to 29.5%. So internally, the signals are strong.
Okay, so everything looks great on paper. Strong earnings, strong revenue, boosted forecast, ad business booming. Which just brings us back to that Friday feeling. Stock drops over 5%. Why? What does this mean for you listening?
Right. This is where we need to dig a bit deeper into the market's mindset. Our sources are pointing to a few key factors. First off, expectations were incredibly high, just stratospheric. The stock had already run up, almost 100% in the last year, and over 40% just since January. So Wall Street might have had Netflix, priced for perfection. Anything less than absolute perfection wasn't going to cut it.
Okay, so it's the classic buy the rumor, sell the news maybe. Or just expectations getting ahead of reality, even a great reality.
Sort of, yeah. It's like the bar was set so high, even clearing it impressively wasn't enough of a positive surprise. Then there's the second point, which got a lot of attention. Engagement trends. Some sources called the growth in engagement anemic, which sounds harsh, but let's look.
Anemic. What does that mean specifically?
Well, total hours streamed, so how much time people actually spent watching Netflix, it only went up about 1% year over year in the first half of this year. Now, compare that to the second half of last year, 2024, when it grew 4.5%. That's a noticeable slowdown.
Only 1% growth in hours watched. Okay, I can see how that might raise some eyebrows.
Exactly. Because Netflix keeps talking about capturing that, quote, remaining 80% of global TV viewing time, content. If engagement growth is slowing, even with more members, it raises questions about, their ability to really grab that massive share. And that could impact future pricing power, too.
Right. If people aren't watching more, maybe they're less willing to pay more down the line.
Precisely. It feeds into the long-term growth narrative. And then there was a third factor, a warning from Netflix itself about the future.
Oh, what was that?
They projected lower operating margins for the second half of 2025. They explained it's mainly due to higher content amortization costs, basically, the accounting for how they spread the costs of their big, expensive shows and movies. Think about the huge productions they have. As those land, the costs hit the books. Plus, higher spending on sales and marketing for that bigger content slate.
Okay, so higher costs coming, slower engagement growth, and sky-high expectations already baked in. That starts to paint a picture of why the stock might dip.
It does. It adds nuance to the headline beat.
So how did the analysts, the Wall Street pros, react to all this? Did they slash their ratings?
Actually, it was more mixed, more nuanced than you might expect. There wasn't widespread panic. You had some, like JP Morgan, who stuck with a neutral rating. They basically felt, yeah, the expectations were already too high. But others, like Rosenblatt, Needham, Bank of America Securities, they actually kept their buy ratings. Some even nudged their price targets slightly higher.
Really? Even with the engagement concerns?
Yeah, they acknowledge those concerns, definitely. But they also pointed to the upcoming content slate. They're banking on huge releases like Squid Game Season 3, the next Stranger Things Wednesday. The hope is that these blockbusters will pull engagement numbers back up sharply in the second half of the year, reignite that growth.
So they're betting on the content pipeline to solve the engagement issue.
Essentially, yes. They see the financial engine is strong, and they believe the content can overcome the recent slowdown.
Okay, so wrapping this up, for you listening, it really is a fascinating situation. You've got this company, Netflix, firing on almost all cylinders financially, making smart moves, growing key areas like ads. But the market, it seems to have this insatiable appetite for more, especially more engagement, more proof of dominating our screen time. It really shows that sometimes even really good news just isn't quite good enough for Wall Street's expectations.
Absolutely. And it leaves us with a really interesting thought, doesn't it? What does it really signal when a company delivers strong results, beats estimates, raises guidance, and the stock still falls? How much further can extremely high investor expectations realistically push a stock, even when the company itself is performing very, very well? It makes you wonder about the limits of that expectation game, especially for these big tech and media giants. Where does the growth story top out, or at least pause for breath?